when we will be discussing the topic of sources and uses of short-term and long-term funds. And joining me in this discussion are my fellow members.
Joniela Bajo, Erica Pedrosa,
Chigrita Odea, Ranilyn Calceta,
Terry Cubacha,
Ashley Demeno,
Anthony C. Milano.
Good morning, everyone. My name is Ashley Raven Mina. I will discuss the equity financing for this part. So, equity financing refers to issuance of new shares of stock and retained earnings plowed back into the company, into the operations of the company. So, equity financing is the safest source of financing for a company because it does not require any mandatory payments of dividends. Equity financing also provides the company financial stability. So when we say equity financing, it refers to the process of raising capital by issuing new shares of stock and retaining earnings that are invested into the company operations. So one key aspect of equity financing is the issuance of new shares of stock, or by selling the additional shares a company can raise their funds from investors who become their shareholders. So when we say retained earnings, it is a profit that have been reinvested back into the company instead of distributed as dividends to shareholders. So instead na gin-distribute nera as dividends ini na profit, gimbabalik la ini nera era company for their operations. Of course, for their ma-enhance it era overall value it era company. So the third statement here is the equity financing also provides the company financial stability. This means that if the company is 100% financed, or let's say leverage ratio is habubo, so makakatrack kita hinihin mga investors, like ang teacher Rinel says that if the company have a lower leverage ratio, makakatrack kita hin mga investors, which means that it aton money or it aton profit is liquid pa, or liquid, bagan nagbabalik-balik lahiya, or nakaka-operate pa na aton business. So equity financing offers companies a safe and flexible method of raising capital. It provides a financial foundation, allowing companies to invest in growth opportunities and withstand economic uncertainties. This is the natures of equity financing. So let's go to the disadvantages of equity financing. There are 3 disadvantages of equity financing. But first, let's discuss the first disadvantages. The first advantages is the cash dividends are not tax deductible. So one of the disadvantages of equity financing is that cash dividends paid to shareholders are not tax deductible for the company. So dividends are typically paid out after tax profit. So maram naman kita ito na it dividends aminin mga profit na gindi-distribute tikatuha mga shareholders. But paano, or bago ito distribute, makukuhaan ana ito in tax. But diri ito gin deductible, or diri tiya bagan tax deductible. So it is one of the disadvantages. So once na diri nira or diri niya ini kuhaan hin task, or marireduce ini it advantages ito sa nga company compared to other forms of financing like debt financing or ano pa it mga iba ng mga financing ini. So ikadua na disadvantages is offering new shares to other investors may dilute the ownership stake in terms of percentage of the existing stockholders. So when we issue new shares to the investors, may dilute it aton mga shareholders or it era percentage it aton mga existing share stockholders. Kayo once na mag-distribute kita or mag-issue kita in new shares, of course, itaton makukuha ito, or itaton mga existing stockholders, itaton mga makukuha na percent is guti ay kisahan mga new stockholders. So, amo ito sa usapan na disadvantages para hit equity financing. The third one, it is most expensive source of financing. At the onset, it does not appear to be expensive because there are no mandatory payments for dividends. So, while equity financing may not involve any mandatory payments or dividends, it is generally considered as more expensive source of financing compared to debt financing. So, as the company value increases, the stockholders may benefit from higher stock prices. So, equity financing also requires in mga expenses, in mga expenses, amo init parang masasabi na expensive it equity financing. So, like mga new shares or pag-i-issue natin ng new shares, nakaka-kuan kapito ng mga expenses. And of course, i-increase it aton overall of financing, it aton expenses. So, and this is important to note the disadvantages of equity financing. So, it is important to note that the choice between equity financing and other source of financing depends on various factors. So, including the company's financial situation, growth prospect, and risk appetite. While financing has its disadvantages, it also offers benefits such as flexibility, not requiring regular interest or principal payments, and the potential for long-term growth. So this is the disadvantage of equity financing. And of course, once again, the equity financing can also come from the different sources. The most popular is essential public offering. When we say essential public offering, it is an IPO or the acronym of IPO. For the companies which are not yet listed or stock rights offering for companies which are already listed. But startup or new companies can consider offering their companies or venture capitalist for equity financing. So, pwede gap nimo inihiya na equity financing or mga baguhang kapalan ng mga companies, pwede na equity financing, hindi mo makonsider na financing. So, thank you for listening and I hope you learned something on my report. Thank you.
Pecking order hypothesis. It states that companies prioritize their sources of financing from internal financing to equity and consider equity financing as a last resort. An example of pecking order hypothesis is that debt holders enjoy a lower return than equity stockholders because the formers are entitled to a higher asset claim if the company runs into bankruptcy. An obvious implication of the pecking order is that highly profitable firms that generate high earnings are expected to use less debt capital than those that are not very profitable. Pecking order is important because it signals to the public how the company is performing.
So I am Ranilyn Calceta and I will discuss the topic of sources and uses of short-term funds. This topic explores how companies employ short-term financing for day-to-day operations, working capital needs, and addressing maturity obligations through bridge financing or short-term loans, ensuring smooth cash flow management. So short-term funds can be obtained from 6 various sources, which may include: first is the supplier's credit. Supplier's credit is a valuable source or short-term working capital, emphasizing the importance of maintaining a strong relationship with suppliers by honoring credit terms, paying obligations on time, and potentially negotiating favorable terms through a history of being a reliable customer. Second is the advances from stockholders. Advances from stockholders allow an uncomplicated means of raising funds for the companies when financial needs arise, with the stockholders charging an interest on the advanced amount if desired. Third is the credit cooperatives. So credit cooperatives requiring membership can lend up to 5 times your equity or contributions, allowing individuals who are members to borrow personally and provide loan proceeds to their companies. But relying on this practice is discouraged as companies should ideally raise funds based on their own merits.
So, the fourth source of short-term fund is bank loans. Bank loans is an amount of money loaned at interest by a bank to a borrower, usually on collateral security, for a certain period of time. Small and medium-sized businesses can obtain short-term credit facilities from government banks like the Development Bank of the Philippines, or DPB, and Land Bank of the Philippines, or LPB, as well as working capital loans from private banks like BPI and BDO. A good example for a bank loan is a mortgage loan. For this type of large loan, the bank secures the house as collateral. If people defer on their loan, the bank is able to legally possess the home to pay off the outstanding debt. So the next source of a short-term fund is a lending company. A lending company is a financial institution that offers loans to individuals and businesses. Lending companies usually offer different types of loans, such as personal, business, and home loans. Lending process is much faster as compared to banks, but they charge higher interests, higher than the banks but lower compared to a more informal lending, popularly known as 5/6. Banks, credit unions, and peer-to-peer or P2P lending are common examples. They engage in lending activities based on the standards set. They typically charge interest from the borrowers and an earning they make from the lending activity. So the last source of short-term fund is the informal money lending or informal lending sources such as 5/6. So informal money lending is an illegal lending practice. Though illegal, it serves as an alternative and a prime means of easy loan or borrowing. It is found to be common or rampant in all parts of the country, whether urban or rural. It is called 5/6 because for every 5 that you borrow, you have to return 6 pesos. This 20% interest is just for a month. This is a very expensive source of financing and should be avoided. Informal institutions considered are money lenders, pawn shops, family, and peers.
Good day, everyone. So we will now proceed to the discussion about the sources and uses of long-term funds. Long-term funds are be issued for long-term investment or sometimes called capital investment. This includes the expansion, buying new equipment, or buying a piece of land which will be the site of future expansion. Long-term funds can also be used to finance permanent working capital requirements. Long-term investment have to be financed by long-term sources of funds to minimize default risk or the risk that you may not be able to pay maturing obligation. The return on long-term investment may not be realized immediately and therefore require more patient sources of financing. For example, if a new branch of restaurant is going to be opened in a mall and an investment of 2 million pesos is made, which includes the permanent working capital requirements, this investment may not be recovered in a year or worse. There is no assurance that customer will patronize the restaurant immediately and may take some time before potential customer will get to know it. If the source of financing is a short-term loan, say a 6-month loan, and one does not have enough personal funds to shell out in case of emergency, the new outlet may end up defaulting with its obligations when the loan matures. Therefore, for this kind of expenditure, a more patient source of financing is needed. The following are the different sources of long-term funds. First is the equity investors. Equity investors can be issued common stocks. This is the most patient source of capital. As far as the company concerned, this is the safest source of financing. Unfortunately, it is not always available when the company needs it. Even big corporations have to identify a correct timing or opportunity for them to issue more shares. Big companies normally wait for a bullish market in issuing new shares of stocks. During bull market, companies can afford to set a higher price for each share allowing them to maximize the amount that they can generate from public offering. Common stocks can be issued through different approaches. For the big companies, they can use organized stock exchanges like the Philippines stock market. To do this, they had to hire the services of investment banks like Credit Suisse, UBS, or BDO Capital who will underwrite the issue. To offer share before the public through initial public offering or IPO, or stocks right offering for those which are already publicly listed, a prospectus has to be provided. A prospectus contains information that will guide potential investors in making an investment decision. This is prepared through the services of investment bankers. Among the information found in the prospectus are the numbers of shares to be issued, the price per share, the underwriter, business of the issuer, and the industry where it comes from. Risk related to the business, intended use of the proceeds from the offering, historical and projected financial statements, dividend policy and dividend history, members of the board of directors and top managers, and principal stockholders. So second is the internally generated funds. Instead of declaring cash dividends, the company can use internally generated funds for expansion or to finance other types of capital investment. Based on the Corporation Code of the Philippines, there is a limit regarding the amount of retained earnings that a company can keep in its statement of financial position. Retained earnings cannot exceed 100% of the value of common stock, or sometimes called paid-in capital. However, if the board can make a resolution setting aside a specific amount of retained earnings for expansion, then this is acceptable. There are other approaches on how to go about this provision in law, but this topic may be reserved for a more advanced subject in finance.
Good day, everyone. Before I proceed to my discussion, I would like to introduce myself. My name is Janelda Ako, and today I will be discussing to you about banks. Banks are sources of different types of financing from short-term to long-term. They provide lower interest rates as compared to other financial institutions. But they have a lot of requirements and a borrower goes through a lot of process, normally taking a month to 3 months before a loan gets approved. So, when we talk about banks, it is usually secured and safe for our money. And pag sinabi namang short-term banks, it is credit card, trade credit, and secured siya, safe yung money natin, and pwede natin siya magamit anytime, like in case of emergency, may ma-aksidente sa family natin, or like need natin kumuha ng money for a certain problem, or like magkaroon ng financial problem, and kailangan natin agad makakuha ng money, makaka-help ito para makakuha agad ng money. And safe pa tayo, like hindi tayo mag-overthink kung asan na yung pera natin. Thank you. So, my next topic will be bond market. The bond market is a financial market where participants can issue new debt, known as the primary market, or buy and sell debt securities, known as the secondary market. This is usually in the form of bonds, but it may include notes, bills, and so on for public and private expenditures. So, what is bond market? Bond market is the collective name given to all trades and issues of debt securities. So, there are examples of bond market. I know there are types of bond markets. Corporate bond, municipal bond, inflation index bond, mortgage-backed security, debt, and government bond. But they are four main types of bonds. First is the government, corporate, municipal, mortgage, and treasury. So, moving on to the next topic, lending companies. What is the meaning of lendings? Lending is disposing of money or property with the expectation that the same thing or an equivalent will be returned. So, what is an example of lending company? Banks, credit unions, and peer-to-peer lending are common examples. They engage in lending companies based on the standards set. They typically charge interest from the borrowers and earning they make from the lending activity. So, lending company shall refer to a corporation engaged in granting loans from its own capital funds or from funds sourced from not more than 19 person. So, lending companies, these are the same lending companies previously discussed. Some of them are provide long-term loans ranging from 2 to 5 years. These lending companies can process loans faster, but they charge higher interest rates. So, when companies have identified good investment opportunities they want to pursue, financing is generally a combination of debt and equity.
Problems faced by SMEs financing. The following is the reason for the inability of SMEs to take advantage of available financing. Number 1. Limited track record. Number 2. Limited acceptable collateral. Number 3. Inadequate financial statements. And the number 4. Lack of business plans. The potential creditors of the SMEs cite following reasons for rejecting the loan application. Number 1. Poor credit history. Number 2. Insufficient collateral. Number 3. Insufficient sales income and cash flow. Number 4. Unstable business plan. And the last, number 5. Poor business plans.
Hello everyone, I am Jinrika MLD and I will discuss the topic about the duties of the borrower to creditors. We all know naman diba na when we borrow money, magkakaroon tayo ng obligasyon sa ating creditor or sa intangan natin. There are 5 duties of the borrower to creditor and I will discuss it one by one. First is pay the creditor based on the payment schedule agreed upon. One way of establishing credibility is paying obligation on time. If you cannot pay on time, notify the creditors ahead of time. But as much as possible, pay on time. Coming up with different reasons for not paying on time creates bad impression. For example, you borrow money and you and the creditor have agreed on a date where on that day you must pay. But when that day came, you had no intention of paying the creditor because you wanted to pay tomorrow or next week. Sometimes, you wait for the creditor to come to you. Of course, what will the creditor think of you? They won't let you borrow money again next time because you don't follow what you agreed on. So you must follow what you agreed with the creditor because it's your obligation to pay on time. The second is provide the collaterals as agreed upon in the loan negotiation with proper documentation. This happens when you take a loan from the bank you agreed on collateral. Sometimes you make a collateral with your assets such as house and land, but of course you will present a proper document that proves that the property you are making collateral really exists, and you need to show a document to prove that the property is really yours. Number 3 is comply with provisions of the loan covenants such as maintaining certain liquidity and leverage ratios. These conditions are supposed to benefit the borrower so that his company will not be overexposed to borrowing, and he will be tasked to monitor the liquidity positions of the company on a more regular basis. Another provision in the loan covenant has something to do with getting permission to declare cash dividends. Secure that permission first before declaring dividends. The reason these requirements is included in the most loan covenants is because there had been some companies in the past which declared cash dividends to some stockholders at the expense of debt services to creditors. Number 4 is notify the creditor if the company is acquiring another company or the company is now the subject of acquisition. The interest of the creditor may be jeopardized if new owners take over the company or if the company is going to acquire another company. Number 5 is do not default on the loans as much as possible. Aside from the creditors, there may be other parties such as guarantees of the loan who will be put at a disadvantage if the borrower defaults. You have to do your obligation as a borrower because if you fail to do your obligation as a borrower, there are other parties that can be affected. As with the company, the stockholders can be affected. Your company can go bankrupt due to your defaulting on the loan.